The S&P 500 as a whole is up around 4.61% in the month of May, and when we take a look at the heat map, we do notice a trend with a lot of companies up significantly, double digits, although we also see a fair number of companies that are in fact down significantly, like the energy industry as a whole. Today's episode, we are going to look towards the month of June for 4 undervalued dividend stocks to buy now. We're going to run through each one's historical performance. We'll look at their dividend safety. We'll do a deep dive looking at their metrics, free cash flows, as well as growth on the ROIC and net debt to EBITDA levels. And as always, we will run through the valuation model. We want to get to our own intrinsic value, explain what our own acceptable buy price is, incorporating our margin of safety. And as always, for each one of the 4, we'll look to Wall Street, see what is the implied upside in terms of percentage and their price target over the next 12 months. So the first one that we're taking a look today is Johnson & Johnson. Now, firstly, to note, this is trading right there towards their 52-week low. It is one that we do see a double buy rating, seeking alpha, as well as Wall Street. We do note a hold rating from Quant currently. Over the last year, well, they are down around 6%, although if you've been a long-term shareholder, you would be up around 45%. Not the greatest return. Also, factor in if you were a dividend investor who reinvests those dividends into the company, you would be up slightly higher. And what we can in fact note is the current yield does sit fairly high for Johnson & Johnson, which we'll look at comparatively. 3.37% on a forward-looking basis, and the forward P does sit just under 14 when the S&P on average sits around 22. So in terms of this company, well, dividend safety score 99, very safe. Whilst on our deep dives, we do look at their balance sheet. Today, we're just running through high-level metrics. However, they do have one of the best balance sheets in the world with a very strong AA rating, similar to that of Microsoft. And we do have a market cap, 354 billion. They are a mega cap company. Now, the dividend safety was reaffirmed just a few weeks ago. So what this essentially means is that a dividend cut does look to be highly unlikely for this company. In fact, that is the highest score that is possible to obtain. Key metrics, well, last recession, 07-09, they did increase the dividend. They did have recession sales, negative 6%. Bear in mind, above the average with the S&P around negative 12. They also significantly outperformed the S&P, negative 27, when the S&P itself returned negative 55. Dividend growth. Now, on this channel, we always say a bare minimum of 4% just to keep up in line with inflation. That is what they got. Pretty poor, I guess, for this company, given the fact that over the last 5 years and the last 20 years, we do see mid to high single-digit growth. But overall, at the bare minimum, they are including it up in line with that inflation. On top of that, they are a dividend king. They've increased those dividends for 50 years or more, and they have been paying a dividend for the last 108 without a reduction. Now, in terms of dividend yield theory, this is something that we cover on every stock. For those that are new, it shows us a company is undervalued when the current yield sits above the 5-year average. So we have a severe undervaluation signal here. 3.37 versus the 5-year of 2.71. Another undervaluation signal with the forward P 13.8 below the 5-year average of 16.4. And a third and final undervaluation signal given the healthcare sector P is much higher at 15.7. Bear in mind, though, we don't look at any one of these models in isolation. For each of these stocks, we do conclude towards the end. Importantly, to understand free cash flow over the earnings, one, the earnings is susceptible to manipulation by management through accounting, and the free cash flow does help us spot any imminent dividend cuts. Now, below 60%, the preference for the majority of companies. A reason behind this for me, it does give me faith where possible management can offer those double-digit dividend increases. Over the longer term, for Johnson & Johnson, it has been below 60%. Last 2 years creeped higher. Nice to note, anticipated 2024 to come down to 54%. Free cash flow, very important for companies. You want to invest in companies that produce consistent and increasing free cash flows. Now, Johnson & Johnson have increased it over the longer term and anticipated to increase it into 2024 to around 9-11, but there is a little bit of inconsistency that we can clearly see. In terms of the sales growth, well, 3 to 7% for steady moderate growth. Pretty much there or thereabouts for this company, although they do go through periods where it is fairly poor, 2019 to 2021. The more recent year, 6%, so at the upper end of that target. On a trailing 12-month basis, 11%. That does look very strong to note. In terms of total sales then, what we can see here, in fact, numerically 74 billion to 85. So it is growing, but fairly inconsistently over the longer term. What they have done is return some of that excess cash to shareholders' pockets, we can see 2.86 billion in 2014, 2.52 in the latest period. So nice to note, over the longer term, we are getting an added bonus on top of those dividend increases. ROIC, well, one thing to note with this metric, it is very important. It does help us and give us faith that management are able to effectively allocate their capital consistently and, in fact, very, very largely above that 10% minimum we want to see. 23% in the more recent year, 22% on a trailing 12-month basis. So a very positive sign, not just for investors, but also those who could be potential investors in this company. Now, operating margin, it is above 12% over the longer term, and it is consistent, so that is very nice to note. Last 2 years, 28%. Free cash flow margin, again, pretty consistently in the low 20s, 21% in 2023. So I do love to see this in companies, and this is one that I do hold myself, where they have a lot of essential consistent metrics. So you do know what you are getting with them over the longer term. Now, net debt to EBITDA, the earnings before interest, tax, depreciation, and amortization. Remember, this correlates to both dividend safety as well as balance sheet strength. Below 3 is what we do want to see for the majority of companies. Now look, over the longer term, we can see 0.25, and what this means, number of years it would take Johnson & Johnson to pay off all of that debt net of cash on hand. 0.23 expected next year, so it wouldn't even take them too long. We can already see a very strong balance sheet, and we can understand why that dividend safety score does sit at 99. So let's jump into the valuation model. As always, if you enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, we do typically deep dives with companies where we run through every single one of these 4 models. Today's episode, we're jumping straight to the final calculation, and it arrives at $176. This is essentially the average of these 3 models that we see. With a current price of $147, we do use a margin of safety of 10% to start off with every company, and we execute on that if it meets our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. If you believe that for Johnson & Johnson, it is a buy around $159, and then we keep going till it's near the current trading price, and pretty much we do sit at just over a 15% MOS level. 149.81 would be a buy if you believe that is sufficient. For me, this is a high quality company. It is very consistent, but again, different investors will believe different things with companies, have different investment theses. In terms of Wall Street and their forecast over the next 12 months, well, they do see upside of 20%, and they do have a price target of $176. But as always, do let us know your thoughts about these and whether or not you have been buying them even over the more recent period. Now, before we move on to the next stock, just to let you know, we have released our latest free weekly article. If you want to gain access to this or any others similar to like 20 undervalued dividend stocks to consider for the portfolio, click on that pinned comment below. You get instant access, and it is free straight away. There's also this article if you want to take a look at the websites that we do use to analyze stocks on the channel. So the next stock to buy in June is ODFL, Old Dominion Freight Line. Now we have a double buy rating, Seeking Alpha and Wall Street. Hold from Quant. We do know it is trading towards their 52-week low. Now it is fairly strong, up 15% over the last 12 months. If you've been a long-term shareholder, well, this is a very strong company, up 712%, excluding dividends reinvested. Now the forward yield is low at 0.6%, but this is one that does have very strong share price return. Forward P 28.55, so it is higher than the S&P. And when we take a look at this company, their dividend safety does show a sign of very safe 81 score. Market cap 38 billion, a large cap company. Now we also see was reaffirmed a dividend cut does look to be highly unlikely. Now, in terms of the last recession, while they weren't paying a dividend at that stage, they did have below average negative 19, but in fact, they far outperformed the S&P with their negative 22% return. One thing that I like about this company, very under the radar, you don't hear it a lot in the community, 30% up this year on the dividend, 36% on average over the last 5 years, although do note they have only started paying a dividend for the last 6 years, where they have increased it every single year. In terms of dividend yield theory, an undervaluation signal both on the yield as well as the forward P. As we can see, on average, it has been fairly high in comparison to the S&P, around 29.8. And when we do take a look, it does sit higher than the industrials, which is around 19.4. Now, a few things that we do like, the free cash flow, as we can see, it is below 60%. The reason why they can offer those incredibly high dividend increases, 22% last year, 28% expected this year, so comfortably below the maximum that we want to see. Free cash flow also increasing 9 cents in 2014, 371 in 2023, expected to be flat into the next year, so something just to bear in mind, but overall it is moving in the right direction that we do want to see with any company we analyze and consider for the portfolio. Now, in terms of sales growth, very mixed, some very strong years, 21, 22, double-digit growth. However, the more recent year, we do see a drop of negative 6% to their top line. But when we take a look at it over the longer term, they have in fact doubled their top line, 2.8 billion to 5.9 in 2023. Now, we do love companies that return excess cash. Granted, this one does pay a lower dividend, but they do return that excess cash by giving you a larger portion of the company over the last 10 years. Hopefully this is something they will continue to do. And ROIC, a very important metric, as we stated earlier, in the 30s and 40s over the last 3 years. This is very strong, a very important metric that you should really consider and maybe make it an exercise over the next few days to look at the ROICs of companies in your own portfolio. Now, what we see here, operational efficiency, increasing the margin 16% to 28%, whilst also increasing their revenues. That is a very strong double whammy there. Top line increase as well as margin increase. And the same can be said there for the free cash flow margin, 14-15% over the last few years, 16% on a trailing 12-month basis. In terms of net debt to EBITDA, I wouldn't even take them over the last 6 years, 1 day to pay off all of that debt net of their cash on hand, expected into next year as well. A very, very strong balance sheet. Definitely one I would say just to consider. Now, do remember you can grab a copy of this valuation model by clicking on the pinned comment below, where you can also run your own companies through to get to your own intrinsic value as well as your own acceptable buy price. Now, our intrinsic value at $217, a 10% MOS level would indicate a buy at $195, at 15% $184, and at 20% pretty much bang on. So for this, what we would consider a high quality company, ODFL, a 20% margin of safety. In terms of Wall Street, well, their upside is 21%, price target of $211, not far off our intrinsic value. Do let me know below if this is one you have even heard. As I said, it is one that does go under the radar and is a very strong performer historically, not just on the share price, but also on those dividend increases. We then move on to another high quality company. We have covered it before, MSCI, and we do have a double buy rating, although we do know a sell from Quant. It is trading in the lower end of the 52-week range, up around 8% over the last year. Over the last 10 years, up over 1,000%, a very strong historical performer. In terms of the yield, slightly higher than the previous company, 1.3%, and a forward P trading around 33. But again, a lot of people do say that quality does essentially be shown in the high forward P. But again, different investors will have different theses on whether or not this is even an important metric. In terms of dividend safety, well, a lower one than the previous two, 61. It does look to be safe. Market cap, 39 billion. It is a large cap company, and we can see what this essentially means is that a dividend cut does look to be unlikely. Now, in terms of the last recession, well, they did in fact have plus 1.5% sales. There was no dividend paid, so we don't have the comparative data. Again, similar to ODFL, very strong increase this January, 16%, 24% over the last 5 years, and we do know they've been increasing those dividends for the last 9. So what about dividend yield theory? Well, again, we see a very strong signal for undervaluation, both on the yield, and the current forward P around 32, 33 is a lot lower than the 5-year average of nearly 41, but we do know it is higher than the financial sector, but again, for quality, you may need to pay a little bit more. In terms of the free cash flow, well, below 60%, again, another reason why we can see that they can offer those double-digit increases. Even though it's been increasing over the longer term, 38% is still very low, nothing to worry about there. In terms of the free cash flow, well, very consistent increases over the longer term. Again, what we love to see, expected again into 2024. And when we take a look at the sales growth, very strong, nearly double-digit revenue as well. So it is looking very good. The last 3 years been some strong years. Even before that, nothing really to fault. And on a trailing 12-month basis, 15%. We can see, in fact, it has increased 2.5 times, 1 billion to 2.5. If that wasn't enough, well, shares outstanding, as we can see, they have bought back a fair amount of shares, reducing from 117 to just under 80 from the latest quarter. ROIC, again, we only want to talk about high quality companies on this channel, and it has been increasing over the longer term, 35% in the more recent year as well. So again, this will make it very attractive for those that are considering it. Again, you want more good news? Well, we have here operational efficiency, not only increasing their top line, their margin has increased 21 percentage points 34% to 55%, so very strong. And their free cash flows, I mean, over the last 4 to 5 years, in the mid-50s, 40s, very, very strong. Again, something you should not discount at all. Net debt to EBITDA, we can see why the dividend does here now say safe rather than very safe. It is around 2.7 in 2023, so getting close to our maximum level. 2024 anticipated to come down to 2.38, so it is moving in the right direction. We love to see that with all these companies. So let's jump into the intrinsic value. Now today's episode, it is coming to essentially $627. And the current price is a lot lower. So a 10% margin of safety up to 564, 15% 532, 20% 501. It isn't quite there yet at a 25%, so we would say it does have around 20% margin of safety in today's episode. In terms of Wall Street, well, they have a price target, a nice round number of $600. They have upside of 22%, as we said, with a 20% MOS level. Let us know if this is one you are buying. Again, all of these companies we are discussing today, we do see as very high quality. And that trend continues into the next stock, and that is Visa Incorporated with a double buy rating, a hold from Quant. Now this is one that is trading towards the upper end. It does have a low yield around 0.76% and a forward P of around 27.5. Over the last year, it is up very strongly, up 24%. Over the last 10 years, up 411%. This is what we would call a very high quality company, as we're about to see. Dividend safety 99, highest score obtainable, 549 billion, mega cap company, and we can see a dividend cut does look to be highly unlikely. Well, last recession, in fact, they increased the dividend and they had plus 9.5% sales, which was a lot better. Remember, that was negative 12. Dividend increased 16% last year, 16% over the last 5 years. 18% over the last 10 years, so it should be fairly easy to guess what sort of increase we are anticipating in October 2024, and they have been increasing those dividends for the last 15 years. In terms of dividend yield theory, well, again, an undervaluation signal on the yield as well as a forward P at 26, which is lower than the 5-year average of 29, but again, we do note it is higher than the financials as a whole, which does sit around 11.3, but you could argue there are a lot of rubbish stocks that are grouped within that sector. In terms of free cash flow payout, well, again, very low. Again, remember and notice the trend. Those companies with low free cash flow payouts tend to be the ones that do increase those dividends at a very high rate. Free cash flow per share increasing very strongly over the longer term, as we can see here, 3 to 4 times growth expected to continue into 2024. Sales growth, again, very strong, double digit every single year. We have that COVID year, which is understandable, negative 5% to their top line, and numerically speaking, nearly tripled across the last 10 years. If that wasn't good enough, well, they do return excess cash, a lot of share buybacks consistently over the longer term, 2.06 from that latest quarter. And ROIC not only very strong at 34%, but over the longer term it has been increasing as well. There are a few things here that you should really be picking up on, and we have released a video quite some time ago now talking about some of the important metrics. If you want us to revisit that, do let us know. Margins, not only are they very high, 64% in 2014, but they've been increasing 67% over the last 2 years. Same to be said for the free cash flow. It will be very difficult to find companies that consistently produce very high margins that are increasing, as well as free cash flows that are very high for a long time as well, not just over the last few years. Net debt to EBITDA, again, another trend for these high quality companies, not only below 3, but very low, 0.05 in 23, 0.11 in 2024 anticipated, so a very high quality company that you should consider. It may even be one that you are dollar cost averaging into every week or every month, as this is a company that over the longer term does historically perform very well and outperform the S&P. Now, intrinsic value then $319, as we can see, margin of safety at 10%, a buy up to 287 at 15%, not too far off, so we would say it's near a 15% margin of safety in today's episode. In terms of Wall Street and their price forecast, well, $317. Now, they do see a little bit lower upside than the other companies we've reviewed today, 16% as opposed to around the 20s that we have seen. Still very strong for this company. That is a very good high compounder to consider for the portfolio. As always, let us know your thoughts on these 4 companies to buy in the month of June. Whether you're adding to any of them, maybe they're on your watch list, or maybe for whatever reason it isn't one you do want to consider. As always, if you enjoy the content, value was provided, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.